welcome everyone to our webinar on navigating the confusing world of long-term care for loved ones in the grip of dementia and frailty. I know that this is a topic that's near and dear to a lot of you for all the wrong reasons, because I'm sure many of you are struggling today knowing how to provide for your loved ones who are in this situation, and more importantly, knowing how to pay for that care because it's not inexpensive. This is sponsored by First Sun EAP. We wanted to give them a shout out for making this possible. And this is a production of FinLife LLC. We're glad you're here. My name is Neil Angel, and I am going to be your host and presenter tonight. I am president of FinLife LLC, and in cooperation with First Sun EAP, we provide financial education and counseling for people who are dealing with stressors in their life, the things that keep them up at night. And certainly this is one topic that is of area of concern for a number of people, a number of families. And I know it has been for myself and my wife, so we have personal experience with that. We also deal with other topics like how to deal with the financial fallout of death and divorce of a spouse, how to eliminate debt and turn it into a force for good in your life, how to pay for your kids' college without going broke, and a number of other topics. So there's just some examples. I have worked with hundreds of families over the years developing innovative strategies to pay for your loved one's long-term care. And I can share a little bit more about that in just the next few minutes. But what we're going to be focusing on tonight are finding the most efficient ways to fill what we call the gap income needs for retirees. And that is to say, the difference between your non-savings based income and the expenses associated with long-term care. And there are a number of ways to do that, and there are a number of pitfalls along the way to avoid as well. So our focus tonight is going to be on showing you how to pay for the care, to make sure first and foremost that your loved one is taken care of, that you're not going to run out of money, but also how to preserve those assets as a legacy for your family rather than leaving them to the nursing home. I always start by talking about the fact that people today are growing older. If you haven't noticed, and this is an interesting statistic that points out the fact that the growing number of people in our country who are at least 100 years of age or older has grown from, what is that, 32,000 in 1980 up to actually 100,000 today. And here's a question for you. In just 25 years, what do you suppose experts are predicting to be the number of people who are at least at age 100 in the US alone? Well, if you said 1 million, you would be correct. And that's a staggering statistic to think about, but what that means is that with old age comes the downside, and that is a frailty and oftentimes a need for someone to step in and provide assistance with what we call those activities of daily living. So we're going to be talking about that in just a few minutes. Living longer certainly is a blessing in life. There are a number of reasons why it's wonderful that we get to enjoy longer lifespans. We can do more things. We can enjoy not only our grandkids, but perhaps our great grandkids. So to be sure, it's a blessing, but there's also a downside. There is a price to be paid for living too long. Now, before we get into a discussion of options for paying for long-term care, let me just take a quick break and encourage you to think about this as a first step. Because one of the first obstacles that people run into is having the legal authority to make decisions on behalf of your loved one. And if you haven't made proper preparation for that, and that person has now been diagnosed with dementia, they're not going to have the capacity to be able to hand that legal authority over to you. So it's going to be much more difficult for you to navigate that. And what's going to end up happening in that scenario is that the courts will have to step in and make those decisions for you, and that's not an outcome you want. It's difficult enough having to navigate this with the authority to make those decisions, but not having the ability to act on behalf of your loved one makes it exponentially more difficult. So as a first step, let me encourage you to obtain a power of attorney for your loved one. Now, there are a number of types of powers of attorney. There are what are known as durable powers of attorney. There are springing powers of attorney, and those give you the ability to make financial decisions, and oftentimes they spell out the specific things that you can do on behalf of your loved one. You can move assets around, you can engage in contracts and agreements, and so forth. There are also healthcare powers of attorney that enable you to make decisions in the event that that person is incapacitated as far as their last wishes are concerned. And there may be situations where they are no longer able to make those decisions, where you have to make a decision on whether to provide life-saving care or not. And so those are very important tools that you need to have in your tool chest. So bottom line, folks, make sure that you have your ducks in a row when it comes to legal authority. A lot of times when we talk about planning for long-term care and assistance with increasing frailty of old age, where ideally you want to make those plans before the crisis happens. It's never a good idea to dig your foxhole while the bullets are flying. And certainly, to the extent that you can do those things before that happens, you're going to be greatly advantaged because your options are far greater than they would be beforehand or after the fact. Having said that, I know that a number of you are struggling right now because you're actually beyond that point and you're having to make decisions on behalf of perhaps elderly parents or other loved ones because decisions had not been made beforehand. So we're going to focus our efforts from here on some of the options that you can perhaps take advantage of during the crisis period of their lives. Now, before we get to this period, retirement is characterized generally by three different periods of life. The first is what we call the go-go years, which is the years of early retirement when you are perhaps doing a lot of traveling, you're volunteering for various local organizations, and you're very active. And then come the slow go years later on, where you slow down and perhaps not getting out as much. But then you advance beyond that to the no go years. And really, that's what we're looking at here. Those are the years when medical issues begin popping up. You perhaps have to be hospitalized more often, and you begin needing assistance for what we call activities of daily living. And those are commonly things like eating, dressing, bathing, toileting, or continence, and mobility. And then a sixth ADL, or activity of daily living, is dementia. So when those kinds of things pop up, then you need to start thinking about crisis planning. So if that's where your loved one is now, we're going to be focusing on some strategies to address that next. So as a starting place, we're going to look at three different people, each of whom is in a little different situation. Their ages are different and the amount of assets they hold are different. And then look at how we might solve for some of their situations. The first individual is a gentleman named Joseph. He is currently 85 years of age. He has just $400,000 in checking and savings, all in cash. He does not have an IRA, so he does not have money that is going to be subject to taxes if he had to use that for long-term care expenses. His monthly care costs are running just shy of $10,000 a month, but his income, principally from Social Security and perhaps a little pension income, only comes to $3,100 a month. So that leaves a gap that has to be solved of $6,400 a month. How are we going to solve that gap? In our second example, we're going to be looking at a gentleman named Jim who is just 77 years of age. That is really very young, but he's suffering from issues related to Alzheimer and dementia. He has been living with his children, but now he needs advanced care beyond what they're able to provide at home. And so he needs help with some of those ADLs that I mentioned earlier. But at the same time, he wants to leave an inheritance through his three grandchildren. Now, in our second example, Jim has considerably more money. He has about 1.5 million altogether. About 900,000 of that is in a combination of checking accounts, savings, perhaps some CDs, and then stocks and bonds. He also has about $600,000 in an IRA account. That money would be subject to taxes if he were to spend it to provide for care. His monthly expenses come to $14,000 a month, and his income from non-savings based sources is about $3,000 a month. So that leaves a gap of about $11,000 a month. And what's more, because he's relatively young, that money is going to have to last much longer than the previous example. So even though he has more money, he's going to have to make it last. And in our third example, Sue is just 69 years of age, but she has Parkinson's, and again, she needs help with those ADLs, perhaps bathing, dressing, continence, or mobility types of issues. And so she's going to need some sort of assisted living to be able to get through. But she's concerned that she may run out of money at the same time. She does want to leave as much money as she can to her three grandchildren. And fortunately, she has a sister, Mary, who is serving as her power of attorney, and she's also concerned about long term care as well. So, Mary is going to be the one tasked with making the financial decisions along with her sister, Sue. Now, in this third example, Sue, who again is relatively young, only has about $360,000. So she's going to have to make that last for her lifetime. And there's no predicting how long she may live. She may live well into her 80s. So in this example, her monthly expenses are $6,000 a month. Her monthly income is $3,000, so that leaves a gap of $3,000 a month. They're going to have to be covered in order to meet her needs. Now, just to, I think, bring home the fact that long-term care is expensive, I want to share with you some of the current rates that are typical here in South Carolina. And first of all, adult daycare. Now, adult daycare is just like daycare, except for adults, where you take a loved one to stay for several hours and they have activities organized and so forth. That might be appropriate for someone, say, with a spouse who has dementia, and that person is more or less serving as their caregiver, and they need a break. And I can just tell you that oftentimes when you're dealing with someone with dementia and you have a healthy spouse who is given the responsibility to take care of that partner, that oftentimes that's very, very emotionally and physically taxing on the healthy partner. And more often than not, the healthy partner ends up dying before the person with dementia. So that's an important level of care that would help provide a break during that period of time for that person. But at the same time, if they need non-medical home care, now this is basically anything that doesn't require a nurse. So we're talking about cooking meals, helping with bathing, some of those activities of daily living that I referred to earlier. Then if you had someone coming into the home at say 40 hours a week, that would run you about $53,000 a year. Now, if they need facility care and they need to be in assisted living, the current rates here in South Carolina are around $60,000 a year. Skilled nursing are for people, though, that require 24/7 nursing care. And oftentimes, these are people who are no longer appropriate for assisted living, and DHEC would require them to move up in their level of care. They may need some sort of tube feeding, or they may have incontinence issues or whatnot that would make them inappropriate for skilled care, so, or assisted living. So you can see here, we're talking about almost $100,000 a year for skilled care. And then memory care is somewhere between skilled care and assisted living in terms of expense. Now, the needs of memory care patients are somewhat unique, and so they have special arrangements oftentimes in those communities to accommodate their needs. I can just tell you not only this, but also from personal experience, I've dealt with this not only with clients and people around the state, but I also have quite a bit of personal experience with two parents who've been through the system through various levels of long-term care, and then also with my in-laws. So it's a very stressful process to try to navigate this. We're actually in the process as we speak of working towards moving my 92-year-old mother-in-law to independent living, and she'll probably need assisted living sometime in the near future. So these are, as you can see here, very expensive. Now, again, once you've determined the level of care that your loved one needs, the next most obvious question is, okay, how are we going to pay for this? And as you know, there are a number of government programs that are available outside of just having to pull money out of your pocket to pay for care. The most common ones are Medicare, Medicaid, and Veterans Assistance. Now, we'll also look at self pay as an option as well, and we'll show you some examples here in just a few minutes. Okay, so let's talk about Medicare. Now, I know a number of you may assume that Medicare does cover long-term care, but let me put that myth to rest. That is not the case. Now, there's some limited exceptions to that, and I'll spell that out in just a moment. They can provide care in a quote long-term care hospital, but more often than not, that is for somebody who is in rehab of some sort. Let's say that someone had a stroke or took a fall and needed physical therapy or occupational therapy, that sort of thing. They oftentimes are provided care in some sort of skilled nursing facility, and these are people who have been inpatients for at least 3 days of continuous care, and they're discharged to a quote unquote long term nursing facility to complete their rehab. There may be some home health services available, and hospice and respite care typically are covered by Medicare. They require a diagnosis by a physician of having a life expectancy of 6 months or less. So those are covered, but oftentimes the other needs are not covered. So I can tell you from personal example, my mother was in assisted living in the last years of her life, and as she advanced to the point where she was diagnosed and needed hospice care, she was in an assisted living facility where she was receiving care for her ADLs, and then hospice was coming in providing care, but it still required us to pay for her assisted living expenses, even though hospice was providing the hospice care. Now, as I mentioned, Medicare does provide limited assistance. As you know, Medicare has a number of parts to it. Part A typically covers inpatient care. Part B typically covers outpatient and physician care. So, in some limited situations, Part A may cover care that that loved one receives in a skilled nursing facility or a long-term care hospital. However, that is typically for a very short period of time, typically 20 days or less, and that requires a qualifying hospital stay of at least 3 days. Now, after the 20th day, then you're on the hook to pay the co-insurance of $240 a day. So if you're looking at a typical month, if you're having to pay and they cover through age 100, or excuse me, day 100, then you're still going to have to come out of pocket for about $6,000 a month, in addition to whatever remaining reimbursement they may cover up to the 100th day. And then after 100 days, then they step out of the picture altogether and you're on your own to pay out of pocket for those services. Now, the other thing I will mention to you as well, a lot of times they will discharge you from care if you're, say, in a physical therapy rehab situation or occupational therapy and your progress peaks. So once the therapist determines that you can no longer recover beyond a certain point, then Medicare will step out of the picture. So even though they say they will cover up to 100 days, typically it's going to be far less than that. So again, just to recap, the maximum they will pay for any sort of rehab care is going to be 100 days, subject to co-insurance, and that would only be following a 3-day inpatient qualifying stay. And again, it only covers rehabilitative care, and the coverage ceases once progress stops. Now, the most common form of government assistance when it comes to long-term care is Medicaid. And people often think, well, we'll just apply for Medicaid and let the state pick up the tab for their nursing care. But I think it's important for you to understand some of the rules of the road when it comes to Medicaid. They do provide care in skilled nursing facilities and in some limited cases community-based care, but they do not provide assistance when it comes to independent living or assisted living. So just keep in mind that they're limited there. Now, in addition to that, they only step in when they have determined that that person has essentially depleted all of their assets. And I'll explain what I mean by that in just a moment. The most important piece of legislation impacting eligibility for Medicaid was the Deficit Reduction Act of 2005. And in that, what Congress did was they extended the look-back period of the transfer of assets from what was formerly 3 years up to 5 years. Let me explain what I mean by that. Prior to that, people were able to transfer assets of their parents' estate outside of the state and put it into a trust of some sort outside of the estate. And as long as they didn't need care for at least 3 years, then they would be eligible for Medicaid because they essentially had spent down all of their assets through the transfer process. But Congress stepped in and said, well, that's a loophole and it provides too many people an easy escape for responsibility, so they lengthened that to 5 years. So what happened as a result of that was that if you transfer those assets outside of their estate and they need care before the 5 year period, then what's going to happen is the state will step in and they will do two things. They will impose a penalty period before which they will actually provide assistance for that person. And at the same time, they'll put a lien on the estate to recover those assets after that person passes away. So with that, at the same time, the legislation provided a carrot. And what the legislation did was they actually entered into partnerships with the states. And we'll look at that partnership in South Carolina in just a moment. But it enabled families to exempt assets from Medicaid recovery equal to the amount of long-term care coverage they were able to obtain through qualified long-term care plans. So let me just say this, before you try to go this alone, I would urge you caution in doing this because it's very easy to find yourself in a situation where you're going to be backed into a corner and have very few options. At the very least, I would encourage you to find a qualified elder law attorney who can help walk you through some strategies to avoid Medicaid recovery, and there are limited strategies available, but don't go this alone. So as I mentioned earlier, Medicaid is a means-tested program, meaning that it is basically looking at people who have a financial need, and there are certain limits when it comes to financial eligibility. The first of which is what they call an income limit, which is a monthly maintenance needs allowance. And for a single applicant, that is just $2,900 a month. And that changes every year with inflation and so forth. There are some things that can be done through a special type of trust to enable the community spouse, that is to say, the person who is living at home who doesn't need care, to enjoy a higher income. But again, that's where you would have to engage the services of an elder law attorney. If that parent is single, then they would only be allowed to have $2,000 in what we call countable assets, and I'll explain what that means in just a moment. If, however, there's a couple and you have a confined spouse and a community spouse, that is to say, you have someone who is in in skilled care or community-based care receiving services, and then you have a healthy community spouse who's still living at home. In that scenario, they would be able to have just under $160,000 in countable assets and still qualify for Medicaid assistance. And again, they would have to meet 2 out of 6 activity activities of daily living, and they would have to receive care in a skilled nursing facility. Now, when it comes to what I referred to earlier as countable versus non-countable assets, it's one of the most common questions that people have. Countable assets are those things that count in considering Medicaid eligibility, and those include things like liquid assets, cash, savings, CDs, IRAs, those kinds of assets. Non-countable assets are things that don't count towards their eligibility. So in that scenario, if you have a couple and you have a community spouse living at home, the house would not be considered a countable asset. A personal vehicle would not be a countable asset. Artwork would not be a countable asset. So there are a number of things that don't count against that individual in considering Medicaid eligibility. I mentioned the monthly maintenance needs allowance, and you can see there, and again, I talked to you about some of the cautions on transferring money outside of the estate. Now, what typically will happen if you do that is that Medicaid will say, okay, we'll provide care, but you're going to have to meet this penalty period, and I'll explain how that's calculated. Basically, what they will do is they will take the average cost of care in the state and divide that into the amount of money that you transferred out of their estate. So let's say, as an example, that the average cost of care was, I don't know, $5,000 a month, and they transferred $200,000 out of the estate with the idea of protecting those assets. What Medicaid is going to do is they're going to say, well, they're going to take the $200,000, divide that by 5,000, and that means that there's going to be a 40-month penalty period before Medicaid will step in and provide reimbursement for those services to the nursing home. In addition, after that person passes, there is a Medicaid recovery process whereby the state will impose a lien on any assets to help recover some of the dollars that were used to support that individual while they were living. So just keep in mind that those are some of the hurdles that you have to face, but we'll look at some solutions here in just a moment. Now, I mentioned earlier that as part of the Deficit Reduction Act 2005, there was a carrot as well as a stick. And what the act provided was a partnership program that states could participate in. In South Carolina, there is the South Carolina Long-Term Care Partnership Program, which helps South Carolina residents protect their assets while receiving long-term care, that is Medicaid assistance, by allowing a dollar for dollar asset protection when using qualified long-term care insurance policies. Now, these are policies that meet specific criteria that are available through insurance companies. Typically, those require a diagnosis that that person needs at least two activities of assistance with two activities of daily living, or they have dementia. So in that scenario, they would potentially qualify for that particular policy. Now, in addition, it does provide asset protection. So let's say, as an example, that you obtained a long-term care insurance policy providing $350,000 in benefits. Well, what that allows you to do is to essentially shield that $350,000 benefit from the asset liens on the assets after that person's death. So let's say they have $500,000 in assets, 350,000 of that would be protected from a Medicaid lien after the fact. It also provides special rules for determining financial eligibility for Medicaid without having to be impoverished. So to the extent that you can take care of this partnership now, it's going to be to your great advantage, and we'll show you some ideas along those lines. It also provides a level of reciprocity. So if, for instance, your parents move out of the state, let's say they retire to Florida, and they have moved, they have obtained a long-term care policy providing a certain benefit, then those benefits would be available in the state of Florida in the way of asset protection. In addition to that, the VA does provide some assistance for veterans and their spouses who maybe need long-term care services. Now, most of you who served in the military are aware of service-connected disability, and those are disabilities that resulted from your service. Perhaps if you served in Vietnam and you were exposed to Agent Orange, or you were injured in battle, or so forth, and you were disabled as a result of that, you may receive service-connected benefits. That could be anywhere from 20% all the way up to 100% a month. This is a different program. This is a non-service connected benefit program. It's also called the Veteran Aid and Attendance Benefit. And as you can see here, this is just an illustration of some of the monthly benefits that may be available to a parent or their spouse, depending on which person needed care. Now, it doesn't provide full freight when it comes to long-term care expenses, as you can see here. It does provide care for people who are in at least assisted living or perhaps memory care or skilled care. But the most appropriate use of this would be for someone who's in assisted living, because it would go cover the gap far more efficiently than would be the case if someone is in skilled care. Now, these are not the most recent figures, but I think their point is made. Now, in this particular program, the VA has established its own criteria for eligibility. Now, these are a little bit different than Medicaid, as you would expect. So let me run through these real quickly, and if your loved one qualifies, that might be an option for them. They had to have served at least 90 days of active duty with at least 1 day during wartime. Now, the VA has established various periods of war, and they have dates associated with each of those periods. You can look those up online. You just look up wartime periods for VA aid and attendance benefits. They had to have served at least 1 day during wartime. Now, it doesn't mean they had to be in combat. It's just that they had to serve during that time. So as an example, let's say that you have a parent who was in Vietnam and they served. Depending on whether they were in country or out of country, then they would perhaps qualify. So, in addition to that, they cannot have received a dishonorable discharge. The surviving spouse, let's say that the veteran has passed away, the surviving spouse has not remarried at the time of his passing, but if they did, make sure that the spouse remarries another wartime vet. In addition, they have to require some sort of assistance with those activities of daily living that I mentioned. And the VA has also recently imposed certain income and countable asset criteria. I'll go over those in just a moment. And finally, they have to be at least 65 years of older or totally disabled. So again, in terms of eligibility, the level of care, you need assistance with at least 2 of those activities of daily living, or if you're bedridden, or if you are a patient in a nursing home due to loss of mental or physical abilities, or if your eyesight is limited and you only have, say, 5/200 or less in both eyes, then you may be eligible based on your care needs. Now, in 2018, the VA imposed new regulations and means tested this program considerably more than had been the case beforehand. Before 2018, we were able to work with a number of families to transfer assets outside of the estate in order to qualify, but they have since imposed a 3-year look-back period, very similar to the older look-back period for Medicaid. So if you're moving money outside of the estate and they need care within that 3-year period, well, you're going to be out of luck. Now, in addition, they have to have accountable income that's less than the maximum annual pension rate. And again, just think of it in terms of that gap need. If they're receiving, let's say, $3,000 a month in some sort of a pension, Social Security, and so forth, but their care needs are $4,000 a month, that leaves a $1,000 a month gap, and in that scenario, they would qualify. So again, in terms of countable assets, they've also changed this considerably. Prior to 2018, they could have unlimited assets, but they've since imposed a threshold of just under $160,000 in order to qualify for this program. So they again, don't include certain assets like a primary home or a car, much like Medicaid. So now that we've covered some of the government options to provide assistance for your long-term care needs of your loved one, that leaves the fourth option, and that is paying out of pocket. So then the obvious next question will be, how are you going to pay for care if you have to pay out of pocket? And then which assets will you liquidate first in order to meet those needs? So we're going to address that next. So when it comes to a typical person's estate, they basically have three buckets of wealth. The first of which is the monthly income. That's the amount of money they're receiving monthly, either in the form of wages or business earnings or Social Security or pension or rental income on properties they own and so forth. So that would be the most obvious starting place when it comes to providing for their long-term care needs. In addition to that, they have their savings. Now, their savings may be in the form of qualified retirement accounts like 401ks or IRAs. There are certain tax considerations when it comes to liquidating those accounts to pay for care you have to be aware of. They may also have savings in the forms of CDs or money markets or so forth. They may have life insurance and they may have long-term care insurance. And then last but not least, home equity. Now, when it comes to home equity, it's essentially that's a frozen asset. And I'll explain what I mean by that in just a moment. Now, if your parent has a home and it's bought and paid for, they no longer have a mortgage on that, and let's say the home is worth $500,000. Well, that is an asset in their estate, to be sure. The problem with that is it's a frozen asset. So, in a sense, it's almost like you're sitting on top of an iceberg, but you're drowning of thirst because the asset is not in a form that you can use to sustain your needs. So, how do you deal with that? Well, obviously, you could sell the house and just take the income from that, or take the equity out of that by selling the house. Alternatively, you can access the equity by way of some sort of a line of credit. And typically, for people who are at least 62 years of age or older, have access to a what is called a HECM loan, and it's basically a reverse mortgage. And typically in this situation, then the banks will lend anywhere between 40 to 60% of the market value for the home, either in the form of a line of credit or a lump sum or monthly income. So that is an option that's available. However, it's important to realize that if you have a single adult who needs some sort of facility care, that's no longer going to be an option because the minute they move out of the house, then the bank's going to come looking to collect on that loan within 9 months of the time they move out. So it's only as good as you have one of the spouses at least living at home. Now, if they're receiving home care, obviously that's going to be an option to enable you to unfreeze some of those assets to pay for that. So it is definitely an option, and in some cases, it may be the most appropriate. Now, when it comes to paying out of pocket, again, home equity loan, your reverse mortgage, that sort of thing is an option, selling the home, but that's typically not the most attractive option for most families. So I'm going to go back to the three individuals we looked at here. We're actually going to look at a fourth individual as well and look at some options for paying for long-term care. Now, these are, believe it or not, this is like buying an insurance policy on your house when it's already on fire. And so just stay with me for a moment, but I'll explain how these work, and they can be a very effective option in stemming the flow. Okay, so let's get back to Joseph again. He's an 85-year-old individual. He needs memory care. The family is considering three different memory care options. He's had multiple mini strokes and he has congenital heart issues. His daughter fortunately has power of attorney and she is concerned that her father may run out of money. So in his situation, he has about $400,000 left. All of it is essentially in cash. None of it is in qualified retirement assets like IRAs. But his expenses are running at about $9,500 a month. And after his income from Social Security and so forth, he has a gap of about $6,400 a month. Well, they could take that $400,000 and just pay out of pocket, but certainly that's not going to last very long if they do it that way. And it's very possible that even in a short period of time, at that rate, that he could run out of money. What if there was an option to fund that gap and also preserve capital as an inheritance for the family? Well, as a matter of fact, there is an option or a couple of options. So we'll look at the first. And most advisors are going to tell you what he can do is take that bucket of cash that he has and convert that into what is called a SPIA. And that is a single premium immediate annuity. It's a life only. So it's going to pay as long as he lives. Now, the upside is that at least you know that he's never going to run out of money in that situation, and that his care needs are going to be met until he dies. But in his situation, he only had $400,000, so that's not going to be an option for him. He just doesn't have enough money to cover that gap. But fortunately, there is another option, and that's what we call forever funding. And in this situation, what we're looking at now is not just a single premium immediate annuity, but we're actually looking at a medically underwritten annuity. It's called a medically impaired annuity. And so this is much like life insurance with a couple of key differences. When you buy life insurance, what is it you're insuring against? You're insuring against the likelihood that a loved one will die too soon and there's going to be a loss of economic power as a result of not having their income. But with an annuity and a medical annuity, what you're doing now is you're buying essentially an insurance policy to protect against them living too long. And so in this case, what they have done is they've looked at his medical records, they've seen his pre-existing conditions, and the more impaired his health, the less money it takes to cover his gap income. In this situation, he only needs $230,000 to cover that $6,400 a month gap. So as a result, what has happened is that the family has now saved $251,000, or over 50% of his estate is now safe, and that can go towards an inheritance. Okay, so let's look at the case study number 2. We talked about this. This is a single male with Alzheimer's. He's only 77 years old, and he's currently considering memory care. So in this example, Jim is just 77 again. He has been living at home with his children, but his needs now outstrip what they're able to provide. So they need to put him in some sort of facility to provide for his ADLs. But at the same time, he wants to be able to leave money to his grandkids. So again, he only has about 1.5 million, but he's relatively young and his monthly care needs are about $14,000. So he has a huge gap of $11,000 a month. How are we going to fill that need? Okay, so again, if we look at what it would cost in the form of a SPIA, a single premium immediate annuity, he would need just under $1.3 million in order to fund that $11,000 a month care gap. And the benefit there is that that would provide for his needs the rest of his life. So if he lived into his 80s, that's still going to be there. Now, of course, it doesn't necessarily cover, may not cover inflation and some of those things. So there may be some challenges down the road, but that would only leave about $200,000 left in his estate as an inheritance. Now, on the other hand, if we look at the medically impaired SPIA, that would only require just over $540,000 to cover that need. So the benefit there is by doing that, the family has preserved almost $750,000 in the estate that can be used as an inheritance. Okay, let's look at case study number 3, and this is a single female with Parkinson's who's just 69 years of age, who is already receiving care from family members. So Sue, in this situation, needs help with her ADLs. Her family is no longer able to provide the level of care that she needs, so she needs to be in assisted living where she can receive appropriate care. However, she has relatively limited means. she has less than $400,000, so she is afraid that she'll run out of money. And she also wants to be able to leave an inheritance to her three grandchildren. Now, fortunately, in her situation, her sister, who is a little bit younger than her, has power of attorney, but her sister is also concerned because she's thinking, well, what about me? My sister now has been diagnosed at a relatively young age with Parkinson's. What am I going to do in my situation? So we'll look at that in just a moment. So again, to recap her financial situation, she has $360,000 between her checking and savings account and her IRA. Now, the problem with her IRA money is that any distributions out of that account are going to be taxed. So that will further reduce the amount of money that is available to her. And with a care gap of $3,000 a month, that's a major concern for her. Again, to recap Sue's situation, she has a funding gap of $3,000 a month, but since she's relatively young and she's concerned about outliving her money, then if we were to look at a regular SPIA, it would take $480,000 to cover her needs. Obviously, that's not going to work for her because she only has $360,000. However, if we look to the medically underwritten SPIA, it would only require $160,000, and as a result, that would result in a savings of just over $300,000 in legacy to the family, assuming normal rates of return. So again, you can see it's a very creative way to stem the tide to stop the fire when the house is already on fire. So again, if you have loved ones who are in this situation, they need care now, they have financial resources, but they're concerned if they can afford it, then we need to talk. So what I'm going to do after this is make my calendar available to you. And if you will do me a favor and fill out a quick survey and tell me how I did, then I'll make time available for you on a complimentary basis to look at your particular situation in confidence so that you'll have a clear path forward. Now, I mentioned to you the three individuals who are in a crisis situation, but there's a fourth individual that I alluded to earlier, and that's Sue's sister, Mary. Sue is concerned that she's going to end up in the same boat as her sister because of some of those issues that have happened in her sister's life. So she is in a pre-crisis planning mode. So let's look at what is available to her if she were to make some decisions today. Okay, so Mary is 6 years younger than her sister Sue. She's planning on retiring before too long, but she's still very active and healthy. But she is concerned about long-term care because of some of the family history. And she would prefer to remain at home if she needs care. So what options are available to her? Okay, so in talking with Mary, we asked three critical questions. First of all, if you were sick and needed long-term care, where would you want to receive care? She obviously said she would prefer to be in her home. And the next question is, which asset would you liquidate first to pay for care? And she said she would have to use her IRA money. And thirdly, if we could show you a better way to use your IRA to pay for something, then would that be worth your time? So she said yes. So let's look at what that process bore out. Okay, so Mary has just under $1 million in an IRA. She has just under $500,000 in checking and CDs, and she has another $400,000 in non-qualified assets in the forms of stocks and bonds. So she has a pretty nice portfolio that's somewhere close to $2 million. However, she's concerned that long-term care expenses later in life may deplete those assets. So now, as you're going to see, since Mary is both younger than her sister and she's still healthy, her options are considerably more attractive. So we're able to take $200,000 from a qualified long-term care IRA policy using the benefits of the Pension Protection Act and Deficit Reduction Act, and we can move that into a new policy without having to pay taxes on the transfer because it's considered a direct transfer from one IRA to another. However, this new IRA is going to provide $9,300 a month for life, an unlimited pool of tax-free money that she can use to provide care on a number of different levels of her choosing. And so in that situation, that would mean a benefit of about $112,000 a year tax-free that she could use for long-term care. And that can be used whether she's in home health, home care, assisted living or memory care, or adult daycare, or even skilled nursing care. So it would more than cover her needs during the latter years of her life. But what if she never needed long-term care? Well, the benefit is if she never needed it, then she would pass a death benefit along to her heirs, to her kids or her grandkids, in the form of $232,000 from that same account, tax free. So that's the benefit of using a tool like this for someone. And as you can see, it's considerably more attractive. So if that's something that you would like to take a look at for yourself, I would be happy to run some numbers for you as well. Okay, I want to take just a few minutes to answer a few of your questions. I know that a number of you have been very patient with me through this presentation, and I want to make sure that I address your specific concerns. Now, keep in mind, just ask general questions because I can't discuss your particular situation on a confidential basis in this format. Okay, so the first question was, what if I don't have a power of attorney or the necessary legal documents? How do I go about obtaining that? Well, I can help you with that. I'm not an attorney, but I did stay in a Holiday Inn Express last night. No, seriously, I have access to a whole network of attorneys, and we can make that resource available to you. It's very inexpensive, and it's the best insurance you can get. So before you do anything else, I would encourage you to reach out to me so that I can help put you in touch with the right sources. Okay, second question. Can you help me if I live outside of South Carolina? Yes, absolutely. Every day of the week and twice on Sunday, I can help you. Basically, thanks to modern technology and the interwebs and all those good things, we now have the ability to not only talk on the phone, but we can also visit by way of Zoom or a number of different webinar platforms. And the silver lining of COVID is it took virtual meetings outside of the novelty space and put it into business as usual. So I'm sure most of you are familiar with using Zoom or Google Meet or Microsoft Teams or some of those other platforms to meet face to face and discuss your particular situation. So I'd be happy to schedule to do that. Okay, so the third question is, yes, I would like to discuss my particular situation with you. How do I contact you to do that? Well, I am going to again provide down below the video a link to a Microsoft Forms survey, and it's just 9 questions. I would invite you to fill that out. Tell me how I did. Did I answer your questions? Did I give you some clarity to provide information that you didn't have before you came to this webinar? And if you will do that and tell me how I did, then I'm also going to give you a link to my online calendar and we can schedule a time. So if you are in my area, which is upstate South Carolina in the Greenville Spartanburg area, then we have the option to either meet at my office or if you prefer to meet by phone or by Zoom, we can do any of those 3 options. And I would be happy to do that again on a complimentary basis. So keep your wallets at home. And there may be some things I can do to help you in your particular situation, but if not, I can tell you that as well. All right, fair enough? Good deal. All right, so again, this is the survey. You can't click on this particular slide, but I will attach a link to the survey below so that you'll have the ability to open it up and just answer a few questions, if you will, and we can proceed from there. Okay, I just wanted to close by saying thank you for your participation, for hanging in there with me, and hopefully you gained some new insights that you didn't have before you came today. Thank you again to First Son EAP for sponsoring this, and I look forward to continuing the conversation with you on the other side. So take care.